This is Bazaar Morning Call. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel.
Good morning.
I thought you'd start by saying, last trading day of the week and
I think
long
we said
weekend
it every
coming up.
day this week, right? So
people are questioning our, passion to come to work every day. But yeah, I mean, it's a long weekend coming up, but the market has been really volatile. So I don't know which way it's going to go. One thing is for sure that this volatility is something that can perhaps continue.
Well, I was just chatting with a couple of friends earlier this morning, who are in different parts of the world. And I said, I'm going to go out and I think it's 15, 16 degrees here in Mumbai. They were like, you're getting everything now in Mumbai. India is growing, jobs are improving, GDP is growing, stock market's booming. You're also getting the weather. What happened to us? I was like, yeah.
It's just that 1 week of the year, right?
That's cool, huh? At least we get to experience it.
No, but this is the best weather in Bombay, right? I mean, absolutely. Well, let's just quickly run you through what the weather and the temperature of the market is looking like, right? That's what we do as we begin every day. Now, yesterday was pretty good because we bounced very, very strongly. So, first of all, the 40-day exponential moving average came into view. We broke that. But then kind of bounced off of that level. So about 300 points from the lows of the day is what we saw. So it was a pretty serious kind of a bounce. The only problem is that it's been so volatile, 300, almost 500-600 points off the previous day from the highs, and then a 300-point bounce from the lows. So it's a bit confusing. It's, of course, very volatile, and it has been so for the last 4 or 5 trading sessions now. Now, I'll come back to levels and what sort of, price action can tell us. But just a quick comment on U.S. markets. So equities were buoyant. Nasdaq ended about 1/3% up. This is last night. The S&P was more flattish. The 10-year yield moved up about 5 basis points. We're at about 4.18. But the dollar index, I mean, they both went in opposite directions. Not usually the case, but it happened last night. The dollar index was down about a third of a percent to about 103.25. And I think this should be the low YTD lows. I mean, we've been trading for 2 weeks now, 3 weeks, but I think this should be the YTD lows. Now, you also had data, PMI numbers, the S&P Global US PMI numbers came for the month of January in the US and they beat expectations. But don't get too excited based on that because the labor component was weak and it was at a multi-month low. And labor, of course, I mean, jobs market is what the Fed, etc., is fixated on to try and bring inflation lower. So in that sense, the weekly jobless claims, which we will get later in the US tonight, become a little more important to watch out for. Oil prices, they're back at $80, but they've been largely ranged like the market, 75 to 80 on oil, and of course, 500-600 point range on the Nifty as well. Tesla earnings came, this is after market hours, but they disappointed. The stock, the last I checked, was in post hours down about 6% or so. I mean, I call it talismanic Tesla, lesser so, but at one point, a year and a half ago, that was basically the cheerleader for the market in the US. All right, let's just come back to the market here and read the price action. The immediate resistance after yesterday's strong bounce is the 40 hourly exponential moving average. It's moved a little bit from where we left off yesterday. 21,516 is the 40 hourly exponential average. That's the first resistance level which the market will need to take out. Breaking above and sort of taking out rather the 21,750 mark, which is Tuesday's high, I think will kind of give more confidence more than anything else that maybe we've completed something on the downside. And once again, the market has got enough legs to move higher. So 21,500 roughly, and then above that 21,750 are the two levels. And then once we do that, we'll bring you sort of these retracement levels, etc. On the downside, because we had such a strong bounce off the lows, I mean, that low becomes pivotal, that we don't break it. 21,137 is that number on the Nifty. We got little by way of help from banks. The Nifty bank ended about 0.25% higher. By the way, HDFC Bank, watch out for that one. It sold off very sharply, and yesterday it closed 2% higher. Is there a trading rally at least here, which can develop into something more? More on that a little later. Immediate resistance for the Nifty Bank stands at between 45,440 and 45,786. These are nothing but 20 and 40 hourly exponential moving averages. again, very, very nearby levels. That's what we're putting out. These are immediate resistance levels. And on the downside, I mean, the Bank Nifty should not break 44,489, which is, again, the low that we saw on Tuesday. PSUs continue to charge ahead. The index was up about 3%, and the metals index, the dollar is down. And, of course, there is this entire China stimulus which is playing through. So that pack got a bit of a sugar hit, and we'll see if there is more to go here. The GIFT Nifty will come up on your screen, and we'll look at that with about a 16-odd point lower start. Mind you, we go into a longer weekend. Today is the last trading day of the week. So, we'll have, 2 U.S. trading sessions to deal with when we come back next Monday. So in that sense, I mean, if you're trading and if participants are those who are trading would like to keep it a little light and not be surprised when we come back on Monday with whatever is thrown our way from the global arena. Sonia.
I guess so. I mean, it looks like this is a sell-on rally market. At least that's the trend that you're getting, right, over the last many days in the market. So a sell-on rally and volatility is something that could continue in this market over the next few days. Now, there was large selling by foreign investors yet again yesterday. So FII sold about 7,000 crores in one trading session, and put together in the month of January so far, FIIs have sold almost 34,000 crores. So big money being pulled out of the markets. Now, HDFC Bank saw some pullback yesterday. Would be interesting to see how that shapes up. The stock is still down 14% in the last 1 month. There's been heavy selling, in HDFC Bank from the FII fraternity. But yesterday, it outperformed its peers and it saw a little bit of a pullback. So that would be interesting to watch today. Auto companies could be in focus. Very good set of numbers coming in, whether it's Bajaj Auto, TVS Motor. CAD disappointed a tad bit on the margin front, but otherwise the numbers were not too bad. TVS Motor, in fact, reported record high margins this time of 11.2%. And Bajaj Auto has also got back to 20% margin. So important to see if there are any more margin tailwinds in a couple of these pockets. So I'm going to watch out for them very closely. In the IT space, Tech Mahindra reported a stable set of numbers. It was a revenue beat. The margins improved. And let's see if that can, bat for the bulls this morning. In the global arena, as Prashant was also pointing out, Tesla was the main talking point. The earnings missed street estimates. There was a warning of a volume decline as well. So a little bit of volatility across the globe. The stock was down about 6% odd. But I think largely this has become a bit of a sell-on rally market. Better to be cautious, better to, just take a step back because you don't know which way things could go. And especially in the broader markets, as we've been saying, valuations are looking a bit expensive now. So I think caution is the name of the game.
Well, that's right. I think the January jinx continues, right? In terms of the January series. The last few series, we were mentioning this at the start of the series. It hasn't been too good. And as we speak, unless we have a big 250-point rally or something, then in fact, we'll avoid another down series in January itself. So you just pull up the last few January series. That'll be up for you on the screen. The problem has been the Nifty Bank. That's a big underperformer because of HDFC Bank. But that showed signs of coming back yesterday. So let's see whether or not HDFC Bank wants to defend lower levels. But the FI data, you can't look at it in isolation. If you just look at the net sell number in the cash market. And I say this because the gross volumes in the last two sessions are 70% higher than the gross volumes for last week. I'm not counting Saturday data because obviously they were not present out there. But the gross volumes are very, very large, telling you there is some kind of adjustments taking place with regard to that SEBI circular. And that's the sense you get going by the large volumes you saw out there. And also, yes, they sold closer on 6,000 crores in the cash market, but they added an equivalent amount in the stock futures. So it appears as a bit of a hedging strategy as well that's taking place out there. How are they positioned on index futures? Mildly net short, 52% of their positions on the short side as well. The Nifty options data should come up for you on the screen. Yesterday, in an uptrending market, you had a fair bit of action. 21,400, 21,300 put. Both of them saw a big open risk build up. And there were some signs of writing at around 21,450. Given that premium is at around 90 rupees approximately, you'll get resistance coming in at higher levels. So the broad level you should be looking at is 21,000 on the downside. You get confident once the Nifty gets past the 21,700. Though for the day, just looking at the options data, on the downside, 21,350 becomes important. On the upside, 21,550 becomes important. I'm looking at the Nifty options data and giving you these numbers. The Nifty Bank, important. That one, in fact, has the 100 and the 200 DMA. Yesterday, we breached the 200 DMA and we bounced off that mark. It's very, very crucial that the Nifty Bank has to defend this mark. If that 200 DMA gets broken decisively, we'll see a sharp downslide from there. So you don't want that level to go on the downside. And on the upside, you want it to get higher, get past that 45,500 odd. GIFT Nifty suggesting a bit of a pullback. The January jinx continues, but let's see whether or not the bulls have enough in them to go higher. I think for the time being, we're in that broad range. 21,000 on the downside, 21,700 on the upside, guys.
Okay, well, let's kickstart the show then and get you some money market views this morning. First up, Parul Mittal Sinha of Standard Chartered Bank says that the dollar INR remains range-bound in line with US dollar movements, even as equity outflows increase during the week. She says markets will closely watch the FOMC outcome next week for cues on timings of the Fed rate cuts and the US dollar trajectory. She expects the dollar INR to head lower as positive fundamental drivers such as Q1 positive seasonality, continued inflows ahead of index inclusions remain in place. She expects the dollar INR to trade in a range of 82.80 to 83.30 in the coming week.
On bonds, Parul says that Indian bond yields have been stuck in a tight range. She says this is primarily driven by tight INR liquidity and large fourth quarter state loan issuances, which have likely muted the positive impact of FPI debt inflows ahead of index inclusion. She says markets will closely watch budget outcome on the 1st of February, where the government is expected to target a FY25 fiscal deficit at 5.3 to 5.4% of GDP, resulting in net borrowing estimate between 11.5 to 11.8 trillion rupees.